Hello friends. On the retail review for second quarter FY14, the performance of the retail companies largely was good, driven by festive season cheer. The Q2 performance this particular quarter was largely good on the revenue side as well as on the operating profit side for the companies under our coverage, primarily companies like Cable Kiran Clothing Company and Raymond Limited along with Page Industries. They all reported good revenue performance. Cable Kiran's revenue grew at a rate of 27% on a YOY basis, while Page Industries revenue growth was over 30%. Likewise, for other players like Jubilant Foodworks, others also the revenue growth was quite strong in higher double digit. Now this was largely led by strong channel inventory or the channel sales that takes place before pre-festival season. In case of Cable Kiran, Raymond, normally the secondary channel sales takes place before the Diwali season or the festive season. So that has led to this strong growth, YOY growth in the revenues. As far as Jubilant Foodwork is concerned, which directly sells, which directly has its sale or face interaction with the customer, there the revenue growth of 27% largely came on the account of new store addition, while the same store sales growth for this particular company was again lower at around 6.5%. Now this is the second consecutive quarter wherein we have seen Jubilant sales coming down. This tells us that the discretionary spend environment is still not out of woods. So still people are not spending the way they were spending some 4 or 5 quarters back. Still the demand on the discretionary spend is soft. On the operating profit margin front, when we look at the companies under our coverage, everybody, because of the revenue growth, the operating leverage was felt and hence the operating profit margin expansion was seen for all the companies, predominantly companies like Cable Kiran Clothing, which is one of our preferred pick, along with Page Industries, which we again like. They have seen a strong margin expansion of over 300 basis point in case of KKCL, that is Cable Kiran, and around 235 basis point in case of Page Industries. So strong growth seen from these two players, while other companies like Relaxo also saw margin expansion because of the softness in rubber prices. As far as Jubilant Foodwork is concerned, there the operating profit margin deteriorated. There was the softness which was seen of around 270 basis point, largely because of the inflationary impact. The milk prices has seen a huge inflation, double-digit inflation. Because of that, along with the new store addition, they are building another format called Dunkin' Donuts, where the operating expenses has been very high. So this has led to margin deterioration in case of Jubilant Foodworks. On Raymond also, now after a poor show for 5 consecutive quarters, for this particular quarter, Raymond reported good set of numbers on the operating profit front, on the operating margin front. Lot of cost rationalization exercise that the company has been doing for now 3 to 4 quarters, that has started yielding results. Hence, as a result, around over 200 basis point improvement in the margin was seen in case of Raymond also. So overall, on the operating profit front, things were quite good, quite well. As far as the management commentary was concerned for these players, retail players, the management, despite posting good results on the Q2 front, the management sounded optimistic but on a caution basis. They said that the long-term or the mid-term environment for retail continues to look robust, but because of this inflationary impact, the double-digit inflation, which is still lingering on the minds of the consumer, the demand environment for short-term continues to be soft, and hence they hinted for a short-term caution with commitment towards mid-term and long-term growth story for the retail thing. Hence that is the reason we have not seen any cutback as far as the expansion plan is concerned for any of the players. The expansion plan continues to be the way they were doing the expansion. As far as our stock picks are concerned, we continue to hold a positive view on Keval Kiran Clothing Company. Now, this company has exhibited strong execution capabilities over long years, around 2 to 3 years. This company is in our coverage for now 3 years in a consistent row. And the performance has been very consistent. The management discipline has been tested even in difficult times. The company has been able to earn earnings, that is equity returns of over 15%, 15 to 20%. Along with decent kind of a growth. So we continue to have a positive on the stock, and taking cognizance of the increasing size, the increasing execution capability, and the brand and the strengthening brand equity strength of the company, we have raised our target multiple on the stock from 15x to 20x 1 year forward, which leads us to upgrade our price target for the stock to rupees 1277. So the new target price for KKCL is 1277 rupees, and we maintain our hold rating on the stock. Also, Relaxo Limited, Relaxo India, it has announced and it has gone ex-split. The company has split the stock from 5 rupees share to 1 rupee share, and because of that we have readjusted our target price for the company. Now the new target price for the company is 196 rupees. Along with adjusting the stock price, we also take cognizance of growing professionalism in Relaxo, along with the benefit that it will achieve on account of soft rubber prices. Now rubber prices have again been on the soft ground. Because of that, we have again raised multiple for Relaxo as well. So a new target price for Relaxo is 196 rupees. Earlier it was 890 rupees. So these are the two revisions which we have done in our retail review for this particular quarter. As far as the entire retail environment is concerned, we believe that cautiousness is still there as far as the short term is concerned because of the inflationary impact as I talked about. But we believe that the long term and the medium term story remains intact, and the companies who are driving on the cost efficiency front, they are using their capital in a efficient manner, they are likely to benefit, and hence we continue to prefer Page also, though that is not in our active coverage list. Thank you.